Welcome back to Demystify Sci. I'm Anastasia.
I'm Shiloh.
And today we are talking economics. Specifically, we are trying to figure out what the hell happened to the United States economy around 1970 that has led to the dehumanization of human capital and overall this massive financialization of economic systems.
And there's obviously the departure from the gold standard, but something else seems to be going on. And we think that it might have some technological roots. And that's what our conversation today is all about. How the stock market became the only game in town, which seems to have happened right around that moment.
And our guide for the conversation is a professor of economics from UMass Lowell named Bill Lazonick, who has spent his entire life researching innovation and the role of the firm in a strong economy. And so, in order to understand Lazonick's massive objection to the present day, which is that there's a really big problem with stock buybacks, and that's where we end the conversation, we first have to go back to kind of the beginning of modern capitalism and modern corporatism, which is at the turn of the 19th century during industrialization in Britain, where Lazonick really makes the case that there is a historical practice of what firms are that starts to break down during the Great Depression and fully breaks down in the 1970s, and we are living in the aftermath of that destruction. And so it's one of those conversations where Shiloh and I come into it without really knowing the landscape. I kind of know about the Industrial Revolution, I know about the rise of corporatism, I know that stock buybacks are happening, but I don't know really what they are or why they're good or why they're bad.
We also know a fair amount from our recent conversations about the history of banking, which runs in parallel to this. It's sort of like the water in which we swim for a lot of the conversation that we're having today.
Yeah, so it's like when we talked to Randall Wray, banking was central to his story. When we talked to William Lazonick, he's like, yeah, banking's a thing, but it's not really that important. And so it's really funny to me because so many
Well,
of
he's
these...
like, it's enabled by these changes in the structure of the firm and the corporate evolution.
Yeah, he's like, it's downstream of the firm. And so Lazonick's basic argument is that the firm has died. And the firm has died because it has been looted by financial deregulation of the stock markets, which has allowed for all of these really...
And why that matters too. Like the firm has died and it has made a true middle class impossible, because the true middle class was provided by a firm in which you would essentially have a career for life. And people obviously no longer do anything I mean, I know one person in my life who's at one of those kind of firms still, at the donut factory. But almost everybody is in some sort of role where they're constantly shifting between firms. And that is, in some sense, a symptom of this transition to the financialization of corporations. And that's what we're talking about today.
And I would bin this into our conversations that try to take apart what exactly is happening to us and what does it mean to be living in the aftermath of all of these institutions. Because if you go back to the 1970s, I think that the university system is really strong. I think that the financial system is really strong. I think the corporate institution system is really strong. You have all of these things that are working really, really well for people. And now, some 50 years later, we're sitting around, we're like, wow, these things have really broken down really significantly. And I think that...
Better get your money in the stock market.
Yeah, exactly. And so I'm like, I think that understanding what has happened to science and why science has gone in these weird directions also requires us to understand what's happened to society and the financial markets and economics. And so I really view these conversations, despite the fact that they're outside of our scientific wheelhouse. Like, we don't know as much about this as we do about ATP synthase or the structure of water. But I think that it's really, really important for us to figure it out. And I think that Bill has really interesting things to say about the arc of this evolution of the firm.
It's institutional decay at the end of the day. And it's like, that is a universal process, unfortunately, that we see everywhere when we talk about this aging and lifetime of institutions. And it seems like we're in some kind of gruesome phase of that with respect to the corporate institution. But,
Speaking of institutions.
Yeah. I mean, we're not, but before we get to that, I just want to say that we don't make it all the way to the moment that we're at today. So we're going to hopefully have Bill back and finish this conversation because there's so many details that needed unpacked. And I feel like Nastia and I finally figured out where the crux was at the very end of the 3 hours today.
I think you actually figured it out. There was a revelatory moment where you were like, hold on a second, is this the problem?
Yeah, it took me a long time to figure it out. So there's a lot of questions to follow, and we're definitely going to come back to this. But speaking of institutions, we got our own. This institution is paid for entirely by you guys directly, right? And that means a lot to us here. And it's something we truly believe is the healthiest way to keep this an institution that's focused only on investigations, right? We don't have any conflicts of interest because we're not sponsored by anybody who's making something that has nothing to do with investigating the way the world works. And that is the only way forward for true investigative journalism in the future, as far as I can tell.
You said support us, but you didn't say where.
Tell them where.
So if you like what we do, come support us at patreon.com/demystifysci.
Yeah, we can accrue all of our supporters in one place in such a way that we can meet with you guys every week, which is something that we take very seriously. And we do enjoy that face-to-face time with the people that are providing for this project and keeping the lights on around here. And we want to hear what your thoughts are. We want to hear what investigations you're interested in. So we work for you, and you can support us directly, and that will be a beautiful thing.
And if you really enjoy the podcast and you really want to get even deeper into it, consider coming to our conference in Portugal, which is happening June 12th through 16th of next year. We have 3 people that are absolutely confirmed, which is Andreas Cies, Gareth Samuel of See the Pattern, and Alexander Unziker of Unziker's Real Physics. They're going to be talking about the crisis in cosmology. We have a couple of other names that I'm really excited about that I don't want to announce quite yet, but tickets are going up for sale for that to patrons in December, everybody else in January. And so our last conference was amazing. I was terrified. I think I've told you this before, but I was like, I don't know what we're going to do with a room full of people who are going to show up and they're just going to look at us and expect to be entertained. And it felt like a room full of friends showed up. Everybody was into the same stuff. Everybody was really conversational. It was just, even as we were finishing the last pieces of setup, everybody was already chattering and the room was filled with these super, super good vibes. And so I was really, really distraught after it ended because I was like, man, when are we going to see all these people again? And so we're throwing another one in Portugal. Tickets go on sale soon. We hope to see you there. It's going to be only about 50 people, same size as the previous one, on the beach in June. So that's going to be really nice.
It's a really beautiful experience. And it's another chance for you to support the project and make sure that Nastia and I can put more of our time towards it in the coming years, right? These conferences are potentially a great way for us to raise funds so that we can dedicate more and more effort to these investigations and not get completely distracted trying to keep the lights on.
And I forgot to mention, the topic is crisis in cosmology.
It is. And there is a crisis in cosmology. We will be talking about it. So I'd love to see you there. I'd love to see you over at Patreon. And love to hear your thoughts about this conversation today. So drop a line in the comments section. Come over to Discord. Come over to Facebook. Talk to us. And we'll see you next time.
The scientific revolution starts now. The Demystify podcast.
Let us see in the dark.
With science, you can have a cohesive theory of a biological system or a physical system because you've parameterized all of the pieces. You know roughly how they're going to work together. And obviously, this has its shortcomings and pitfalls, but it seems to work well enough. But there's something about economics that seems just inherently, I don't want to say chaotic, but indeterminate.
It is indeterminate in the sense that it's constantly subject to change. So the physical world doesn't change as rapidly as the social world. Let's put it that way. And we can see that just in terms of, U.S. politics, the volatility of it, and how unpredictable it is, just within a short period of time. but you can also see it if you look for longer periods of time, but not that long. I mean, in the 1990s, for various reasons that I could go into, it was clear to me that China was going to move in the direction and become a major economic power. And that was not a consensus at all. But that's relatively new. In the 1980s, you were not talking about China as being a problem. In the 1960s, you're not, at least from the U.S. point of view, as a competitor, as a geopolitically even, well, at least on the economic side of it, obviously, geopolitically you were. But and the same with Japan in the 1960s. To predict that in the 1980s Japan would be dominating in industries where the U.S. had been strongest was not a prediction that most economists would be able to make. And now you could say that it's just uncertain. My view is that if we study history enough, we can start getting a sense of the parameters of in which change occurs, and then what are the really driving forces of change, and that the economy is again only one part of that, because it's obviously political, social, etc. But you do have to study. So I have a methodology that I call integrating history and theory, which you might just call integrating facts and logic. And I think all scientists would say you have to integrate facts and logic. That the facts are going to affect the logic of your argument, or the illogic of your argument. But the problem with history is it's changing all the time, and it's also, as I said, very hard to do a controlled experiment, because you're looking at so many different factors that are moving at any point in time.
And you also have a little bit of a coastline problem with it, right? Where if you're trying to figure out what pieces of history go into causing some kind of change, you're not really able to fully evaluate everything that goes into that. Because when you have the historical record, you're clearly missing pieces, even from something that's very recent. Because if you look at the texts that we leave behind now, surely there's some, I hate to use the term dark matter, but surely there's some kind of dark matter of everything that's happening right now that's not being written about, that's not being talked about, that's just influencing us without clear signatures.
Yeah. Well, I think part of it is that you have to have you do need a theoretical perspective. But what I mean by integrating history and theory is that the theory that I hold right now is not it is my explanation of what I understand from what I've learned. But what I've learned is by inherently very selective. And I think actually I know a hell of a lot about history, but in the grand scheme of things, it's very selective, and it's also much more focused on how the economy works in terms of companies and industries and the relation between firms and markets and the role of the state. It's broad, but it's still focused. But you have to have a framework that could see how political factors, social factors, technological factors, the physical world intervene and constrain what you can talk about, or actually change the way the world is operating, and then take it back to your theoretical perspective and your area of specialty. So, I mean, I see the economics, and we can discuss this more, that I do is very broad and very historically based, understands different theoretical perspectives and the difference between different theoretical perspectives. But in the end, actually, if I want to say something that means something to people here and now, which I do, I actually have to get somewhat specialized in terms of what I have drawn out of this to see the critical factors are at a particular point in time, and the things that I want to zero in on and know everything about.
You mentioned that there are certain let's say, factors that fall out of your historic analysis, things that do consistently impact the prosperity of nations? And I'm kind of curious what those are.
Well, okay, so when we talk about what we call capitalist society, and almost any society, um, what economics ultimately has to understand. If it doesn't understand this, and I'd say most of what's called neoclassical economics does not, it's how the society gets more productive, how you get growth, how you get more goods and services that we can make use of. Okay, and that requires a theory of innovation, basically, or a theory of productivity growth, which in some ways that I use this, I have what I call a theory of innovative enterprise, but I could call it a theory of productivity growth based on what's being done at the business level. Now, most economists think, and political scientists as well, who trying to connect with economics, talk about states and markets. And somehow the business firm, is something that where inputs just pass through, become outputs, but all the allocation is done because there are people who have money, want to spend money, and demand goods and services, and that allocates resources in the economy. If that doesn't work out to our liking, basically there's some economists, mainly would be seen on the conservative side, that if you try to intervene, you're just going to make it worse. Nothing would work better than the price system to allocate resources. And there's other economists who are on the more kind of American liberal bent, you might call it, who say, no, the markets are failing. We have to intervene. We're doing it for the common good. But we want to intervene as little as possible so that the markets could work. And basically what's left out of that is business organization. And if we look at the organization of almost any successful economy, it's characterized by some large-scale business, quite a few large-scale business organizations that corporations that compete globally.
I mean, how far back does that go? Are we talking all the way to Sumeria? Like where?
No. Well, first of all, yeah, it does in the sense of who ends up being dominant. At least in the history that I've looked at, you could at least go back to British colonialism and the East India Company and the Hudson's Bay Company and basically monopolies that are given out by the British Crown to various monopolies to go colonize the world.
Like the birth of corporations, essentially.
Yeah. And I wouldn't. I've never looked back. I'm not an expert on that, but I haven't looked back further than that.
That's
but
fine.
certainly, okay. Now, the corporations have not always that have driven the economy, or the business enterprises have not always been as big as they have been, because basically, and I think this is something that I looked at historically when I started my career, and I wanted to do this integrating a theory and history. I wanted to understand the British Industrial Revolution, because I think everybody would agree that's the world's first industrial revolution, where you get a huge increase in productivity growth through production and through changes in production and applying technology, steam, power, and you have the railroads, etc., and you have mass production. And the thing about the British economy in the 19th century is that the leading industries were characterized by relatively small firms. So the leading sector in the 19th century was the cotton textile industry in Britain, or the textile industry more general, but within textiles, cotton. And it was Britain actually getting cotton from around the world to produce it and then export it back around the world. That was the basis of British growth in the 19th century. By the third quarter of the 19th century, people are calling Britain the workshop of the world. That's where you're getting production on a scale that you're getting it nowhere else.
Is that all slave labor generated?
So
No.
that's what I was going to say. It was crazy because a lot of this was domestic labor, right? Like a lot of the earliest threads of industrialization is cotton imports being used in the home.
Oh yeah. Oh
to
sure.
produce
Yeah.
textiles.
But
And
what
then
about the cotton itself?
The cotton itself. Yeah, sure. Well, yeah. So there is a famous book written
almost
by
guaranteed.
an economist, Eric Williams, I think, who ended up becoming the president of Trinidad and Tobago, if I remember correctly. This goes back 60, 70 years. Capitalism and slavery, and there's a huge, slavery is very important to the emergence of capitalism. There's no doubt. And wool textiles did not have the same, I mean, you can wash cotton. You can do all kinds of things with cotton that you couldn't do with wool. And the American slavery was very important, although a lot of the cotton came from India. So a lot of the cotton came from Egypt. The highest staple of cotton, the finest cotton, came from Egypt. So there's a whole history there, but and that supplied this input to and the background to that actually was a key part of British colonialism, was called the triangular trade, where the British ships would go to West Africa with all kinds of things that were manufactured in Britain that could be sold there, including Turkish red dye cloth was a big favorite of slave traders. You get the slaves, take them to the Americas, and then bring back sugar, coffee, and cotton, basically. And that was a big part of the growth of trade in Britain, and that was actually generating a lot of profits within that context.
And the corporate architecture was the means by which this was accomplished. Did corporatism allow the expansion of this triangular interaction, or what's the role of that versus whatever was happening before?
Okay, well, yeah, that's first of all, Britain's merchant marine was largely what we might call private in the sense, or corporate. That these the companies that were doing all this trade, the East West Africa Company or whatever, they had an interest, obviously, in fighting off pirates and fighting off other nations. Wars were fought against the Spanish in the 17th century, and then the Dutch and the French over world dominance of world trade. Coming before the Industrial Revolution. Then once Britain had won all those wars, it was in a position to say, okay, we're the dominant one. They had what they called the Navigation Acts, where if you wanted to import something into Britain, there was duties on it, but they were pushing free exports of products from Britain. And dominating in various parts of the world. Other countries were too, like the Spanish and Portuguese in Latin America or in Africa. But the British really had coalesced around the cotton textile industry and cotton, and the American South, the slaves, cotton growing was of critical importance to the growth of British industry. But what that meant was that basically in Liverpool, before it became known for the Beatles, was the center of the cotton trade. And everybody who wanted to import cotton into Britain was bringing their cotton to Liverpool. Okay. And then within Lancashire, which is an adjacent county there, you started getting all these firms producing cotton. And actually, the firms were relatively small, and they would there were spinning firms and there were weaving firms, and there were towns that specialized in coarse spinning, fine spinning, coarse weaving, fine weaving. So it was a highly specialized division of labor, and there was a railroad system got built. This was in the first half of the 19th century to connect all these towns and connect Liverpool. And the employers, the capitalists, they would go, if they were in the spinning industry, to Liverpool once a week to get the cotton they needed for the orders that they had. The orders they had, they actually got in Manchester, which is the city at the center of this, at the cotton exchange. And so the weavers and the spinners would come into Manchester and give their orders. So it was like a market. This is where actually the idea grew up in economics, because markets did emerge, that there was a market out there. It wasn't just like a couple firms doing all of this. There's lots of firms. There were maybe 1,000 firms in the spinning industry, even more in the weaving industry. And from week to week, they were giving orders. They were coming to Manchester Exchange twice a week, getting their cotton. So when you saw this dominating the world economy, this country with this kind of structure of industry, this looked like it was very vertically specialized, horizontally competitive. And this actually led to the idea that markets were driving all of this. And to some extent, it was a lot of individual entrepreneurs were able to get in, start their cotton textile factories, start their weaving firms. Even a lot of the weaving firms were very small. And the idea grew up. It actually coalesced in a book which became the textbook of economics from the 1890s until the 1930s by an economist named Alfred Marshall, British economist, who started talking about the development of the British economy being dependent on what were called industrial districts, or later called industrial districts. But they were basically these areas where there was all kinds of specialization. You didn't need actually a lot of education for those. For people were the Factory Acts kept children out of the workplace for longer and longer periods of time, but still you were going in at the age of 14, even late in the 19th century. The skills were being learned on the job, and one of the things that Marshall said famously is that in the Lancashire cotton textile industry, this is the center, which Manchester's the center, and Liverpool's feeding into it. Skills are kind of, people learn skills as children, and the knowledge of how to do production is in the air. It's just everybody knows how to do this. And so that was a stage of capitalism which was very different than what came after, when it became much more science-based, chemical industry, electrical industry, etc. And Britain actually was way behind in those. It's not that it didn't have the capability. Actually, Britain had a lot. They did have at the same time a lot of science as an advanced economy, but it was less important for these firms. So in this industry, there were a lot of small firms, and that gave economists the idea that small was good, and that small would dominate. And actually, for Alfred Marshall, who was he was at Cambridge University, and kind of an interesting character in many ways, but he actually thought this was good, not so much from an economic point of view, but from a social point of view. It's sort of the idea of the small scale entrepreneur and entry into industry. So this created a view of the economy. Oh, if only markets could work, and that's still the dominant view in economics. If we can get markets to work perfectly, we're all better off. I can come back to that. Now, there is something to
before we get like too far down that road. So you've unloaded a lot of really interesting information here. I just want to make sure that I digest all of it, and I also want to go back to this radical change that happened, right? So prior to the British Empire embracing this kind of, well, it is really a corporate structure, right? It seems like the governments fought these wars to open up these markets and get nice tariff structures so that they can do their business. And then they privatize all of the trade and so forth. They at least allow these charters to go down where people can get together and fund. Why didn't this happen before is my first question. And my second question is, what is the role of banking in all of this? Was that instrumental in allowing this kind of new corporate structure to happen in the first place? Because it seems like prior to this, you essentially have some form of feudalism where the king is trying to finance everything himself and really struggling to stay afloat. I really want to understand this hinge in history.
Well, yeah, I mean, there's limits to how to my ability to answer that question, except to say that, Christopher Columbus, an Italian, was sent by the Spanish to try to find the New World. He didn't exactly know how the world was shaped. He didn't know where he was going, but he found the Americas. Okay, so the Spanish were trying to do this. The Spanish did not succeed, however, in dominating in industry. The Portuguese tried to do this. In the early 18th century, there was a treaty with the Portuguese, whereby Britain said, "You can send us all the wine you want, port, and we can send you all the textiles we want, and in exchange for having this treaty, we'll protect you from the Spanish." Okay, now that turned out to be that treaty killed the Portuguese textile industry. Not that it necessarily would have been as dominant as the British, but that was when it was still mainly the wool industry, okay? And dependent on local supplies of wool.
Were those guys embracing the corporate colonial structure?
Yeah, it was basically nationalist, and it's always been nationalist. The nationalism has never disappeared, but and Britain dominated in that. Now, why Britain? Why it happened then? There's all kinds of stuff that I might have read about at some point that I really would not want to start drudging up about, and probably get it wrong about ship technology, about just being able to have ships that could go around the world, and military technology, etc. But Britain was ideally situated by this because of being on an island, being able to access maritime channels very, very easily.
I guess the simplest form of this question is, how important was loan-making central banking to the ability to make this kind of
decentralized finance in general? Like the corporate invention seems to have altered the face of the earth, and I'm trying to understand like where that came out of.
And because we've had a couple of conversations that kind of touch upon the importance of banks. Like we talked to Randall Ray, who's one of the MMT guys, and he kind of gave us this broad spectrum overview. And the establishment of the British Central Bank seems vital for the corporate expansion that followed, because it was able to fund projects that otherwise would be impossible to fund.
That may be true, but from my knowledge, and again, really the way these companies were funded was they were joint stock, and basically people who had, and the City of London became very important. And I would see banking of coming out of that. If you didn't have all these, the East India trade, you didn't have the West Africa trade, you didn't have the Hudson Bay Company, you wouldn't have had all these opportunities to get involved in foreign trade and make money off of foreign trade, and lend money to these joint stock companies, etc. But the companies themselves were organized as joint stock companies that were basically people who had money putting it into often just a particular venture by the East India Company to India, and then get paid back by the spices, etc., that they brought back. So banking, I see banking as derivative of of industry. I mean, that might be a difference with Randy Ray, that I see industry really as driving the producing the productivity where you need to borrow money and bankers can become involved.
It's kind of a chicken or egg question at the end of the day, I suppose. But it does seem like this is a radical transformation of the way that people are viewing what to do with their wealth, right? Because prior to this, I mean, it's like,
and it also seems like the first time that people are really starting to put together really significant economic theories, right? Where it's like this question of like, what is an economy? How should it work? What are the moving pieces that go into it? Are emerging all from this time where you have the joint stock companies, you have the central banks, you have the transformation of society from feudalism to industrial capitalism. And it's this foment in modern times where it's happening for the first time. And like Shiloh, you said, it's difficult to say like what came first and what came second because they're happening in parallel.
Yeah, I'm all right with that.
Well, it's difficult, but you can study it and find out. you can look at the order of in areas where I do have the detailed expertise. I can tell you. If we're going back to the 17th, 18th century, I've general knowledge that I acquired that was useful for for the focus that I wanted to take, and you could have a debate on that, but.
I think I remember just from talking to Randy that the Renaissance period was a huge revolution in banking structures, right? All of that, like the Italian Medici family and all of this stuff. Yeah.
But this is like
the
much
Bank
later,
of England.
right?
Yeah, we're starting much later.
Like there's these. It's weird to realize just how much history has happened. I think.
Yeah.
Sometimes.
Well, the Rothschilds become very important in this period, and they're in various countries, and they're lending to governments, they're lending to industry. The Dutch are in there, and they're very important because they're also have ships that are going out, but it's ultimately. Once you get to the 19th century, which is where I started really digging in and trying to figure out what happened, you do have an industrial revolution. And
is this in some ways a story of like global capital's search for a productive home?
I think it's a story of just national competition and domination. And in a context where there's this huge there's this huge world out there that can be conquered, and European countries are competing against each other to make this conquest, and this has never really ended. But what changes in the 19th century is the scale to which manufacturing and industry and producing things that can be exported around the world and can make money out of doing that, and can do it using what at the time was modern technology, which now would be very antiquated, of course. That was a change, and again, so that's where I came in, in terms of trying to understand this picture as starting over 50 years ago as a student, a PhD student, really trying to say, how do I understand how this world in which we lived and evolved? I mean, I've always called what I do, I might have mentioned this when we talked before, catching up with history, that I'm interested in what's going on now. Like today I was talking to a fellow who works with me, and we're going to write an article about Pat Gelsinger being fired from Intel, and Elon Musk, his stock option package being overturned. Now, that's a far cry from understanding British history, but actually, to understand what's going on now, I think you have to have this long-run perspective on what's happening in companies that we rely upon, for better or for worse, to produce our wealth. In this case, semiconductor chips and EVs. So that's the world in which I'm looking at. And banking, the role of finance for me plays a very different role. The role of finance is largely now to take money out of companies, not to put money in companies. So what I want to understand in terms of understanding finance, when was the period when finance was structured so that you actually use money to reinvest in companies, to grow companies, to make them more productive, to employ more people, to pay people higher wages, to come up with the next innovation. And I would never see that if I was just looking at banking system.
Yeah, of course. I mean, my first
Yeah.
question when you say that is I'm like, is there a time where that was the case, where finance was used to actually be fed back into systems and into wages for workers rather than for enriching those who own them? This is going to sound very Marxist, rather than enriching those who own the means of production?
Yeah. It's all right to sound Marxist. Yeah. I can get to that as well in terms of the stuff I've done. I don't want to talk. I can hop around here a bit, but if and this is
Well,
much
to,
more
to, to
close.
create like a linear narrative, you basically are
Yeah.
looking at the emergence of this
Yeah.
industrial economy in 19th century Britain, and
Yeah.
you're making the case that what people are missing is this idea of the importance of the firm. The firm
Yeah.
is
Okay.
this mediating force
Yeah.
between, let's see, I wrote down exactly what you said, between states and markets. And so
That's right.
basically you have innovation that occurs inside of the firm. Nobody's studying the firm. You go back and you look at this point where all of this is being born and you're
Yeah.
like, hey, that's crazy. There's all these little firms.
Yeah.
And then
Yeah.
you're looking at the modern day and you're like, something crazy is happening in the modern day
Yeah. Okay.
where
So
go ahead.
yeah. So I think I can answer your question about was there a time when finance was structured for the growth of firms and the growth of the economy and better jobs, and it was basically in the United States and from about the late 19th century until the early 1980s. And there was lots of ways in which finance was not doing that, but there was a financial structure that served the growth of companies. Okay. Now, and part of that, just to make the link back to Britain, was that this happened in the late 19th, early 20th century. Britain started to fall behind. You didn't see it immediately, but it fell behind. And my analysis of it is that it fell behind because its fragmented structure of industrial organization could not integrate the new technologies, the potential of mass production that was being done abroad, particularly in the United States, also in Japan to some extent, and in certain industries in Germany, but particularly the United States emerged as the world's leading economy. And in my own study, that's what once I sort of understood where did Britain come from, really what was driving that was a question at the time, and this coming out of being a undergraduate student and a graduate student in Europe in the late 1960s, was United States was dominating. And so I wanted to understand, how did the United States become dominant? And actually, just to skip ahead a bit, as I was studying that in the 70s and 80s, Japan came on the scene. So then a lot of my work was how did Japan surpass the United States? Now, I don't want to get too far ahead of this, but basically back to the question is you had the growth of large firms in the late 19th, early 20th century. And Wall Street was really abetting the growth of those firms. Now, a lot of people would say, okay, that was mean, awful American capitalism coming to the fore. But in fact, the way a lot of those firms operated, the dominant was that they were creating lots of jobs, they were paying higher wages. It was a white man's world. So that was a world for white men. But that's what you were doing in the United States. And that's how, by post-World War II period, you got a middle class. You didn't get a middle class just by people going from one job to another and this company or that, or even by starting their own company. You got it by working for General Motors, General Electric, DuPont, Standard Oil, etc. And at that point in history, those companies, and some of them, depending on the industry, were doing awful things, abroad or whatever, or polluting at home, or things that Ralph Nader called out in the 1960s. That there was all kinds of problems with that model, but it did create a middle class, and it's what I call a retain and reinvest model. The companies, when they made profits, they paid out a certain amount of dividends to shareholders just for holding shares, and then they put all the rest of the money into the company, and they tended not to lay off their workers unless there was a severe downturn in the economy. And even in the 1930s, when it was a huge downturn in the economy, you had as high as 25% unemployment. These corporations never laid off their white collar workers to any extent. In fact, the 1930s in the United States was a great period for starting research labs, research and development, trying to integrate science and new technology into mass production of goods. And that was reinforced by when U.S. entered into World War II. The government has all these demands for goods, creating all these facilities. So you at that point, the financial system is really working to build industry, not to tear it down. And I can give you a very different story, which I think I've written about most in the last 20 years, is about how the financial system changed in the 1970s and 1980s and beyond to basically take all the value that was created in companies and put it in the hands of what we call the 1/10 of 1%, the billionaires. And I can guarantee you I can explain that better than anybody.
I believe it.
Okay, but yeah. So
as a leading question into that topic,
yeah,
I wonder, do index funds play a role in this transformation and the emergence of these?
Yeah. Okay. The stock market, is a very interesting phenomenon because it's really and I have one article I have written, and it's part of a book I call Predatory Value Extraction, but it was originally an article, The Functions of the Stock Market and the Fallacies of Shareholder Value. So, okay, so the typical view of the stock market is that it's money being put in to that is people buying shares to fund companies, and companies can grow because they're raising money on the stock market. I mentioned the joint stock companies. That was not really a stock market. That was really just knowing a bunch of individuals who had money, then putting them together into a kind of a private enterprise, and then getting some money back. The stock market really it's been around in the United States since the New York Stock Exchange since 1792. There have been all kinds of stock markets that arose in various places, but where it really became important was in the late 19th century, when, in fact, it was a way in which if you built a company, and in the early 20th century, you built a company, you could then take your money out. So I'll give you the example of Andrew Carnegie, which most people have heard of, who built the mass-produced production steel industry in the late 19th century. Okay, it was done as a private enterprise, not as a publicly listed company. Okay? He owned it. He hired people to run it for him. He hired metallurgists who helped him innovate in the way they're producing steel. And his advantage, he came from very humble beginnings. He was a smart guy. He actually worked on Wall Street selling bonds for railroads. He actually worked for the railroad company. I think it was the Pennsylvania Railroad, selling bonds in London to finance the growth of the railroads. Growth of railroads were financed by a combination of land grants given out by the American government and borrowing money, and you would build the railroads that way. It was much less the stock market. Then once the railroads were built, people were trading the stock on the stock market. Now, when Andrew Carnegie, he from that position, he saw that the Pennsylvania Railroad was one of the the big transcontinental railroads that were built in the last decades of the 19th century. And he knew that there was going to be this huge demand for steel rails, and that if he could mass produce those, he could dominate that market. He invested that to the extent, and this makes British capitalism looks pretty frail, that he bought up the iron ore fields in the Mesabi Iron Range, built his own railroad to Pittsburgh. It was an integrated operation, and he could mass produce these rails and grow like crazy. And then they mass produced other types of metal as well. But then in the late 19th century, he was off. He had originally come from Scotland. He was off in his castle that he had bought in Scotland. He had a guy named Frick running the company. He wanted out, basically. Or he didn't want out, but he could be bought out. So J.P. Morgan came along and said, around 1900, we'll buy you out. And what we'll do is we'll merge your company with other companies. It ultimately became U.S. Steel. And we'll have an even more dominant company in the steel industry going forward. At first he refused, but then they came back a year or two later and they gave him an offer he couldn't refuse. And so he then sold out. What happened then, the stock market did not create U.S. Steel. The stock market allowed Andrew Carnegie to exit and to take his riches. The merger was done with bonds, and then they issued stock to pay themselves back, basically. And the stock was issued over time. First, it was in technicality preferred shares, then common shares. But basically, the stock market was derivative of the existence of U.S. Steel. It did not finance U.S. Steel. It was derivative. It was a way of transferring ownership to a bunch of shareholders who had nothing to do with the company from the original people who built the company.
So you're like, there's inherent value because there's a company that has produced something that is out in the world with contracts, with supplies, with distribution, and then the person who owns it is like, I want to get out, and then sells it to shareholders, and then leverages the profits off of that sale in order to be able to actually exit and make it into something.
And they make money, and they might, the banks then might have something to do with the company, or they might not. Now, what I've just described is actually the Silicon Valley venture capital model, but with different institutions, which emerges in the 1970s. Because what venture capitalists call, let's say, if they invest in an Apple, Cisco, Oracle, Google, or whatever, they call doing initial public offering, going on the stock market, an exit strategy. Okay, now they might raise some money in that process, but as I often say with Apple, for example, the only time it ever in its history went to the stock market to get money was in 1980 when it did its initial public offering, and it got $97 million. It wasn't critical at that point because they actually already had a product, but it was useful. But that was it. After that, everything was coming out of Apple, either in dividends or stock buybacks, and they've been the biggest repurchasers of stock in history. I can get into that later, but so it's all, the stock market is a value extracting institution much more than a value creating institution, and it's a way of actually taking money out, separating the ownership of the shares of a private company from the control of the company. So when you separate the ownership and control, the shareholders, I can go buy shares in Tesla, I can go buy shares in GM, I can, even if I have a couple $1 billion, I can go buy shares in those companies. I do not, by virtue of buying those shares, have control of those companies. If I had right now with let's say Tesla's valuation, if I could go buy $500 billion worth of shares, I might have control. But I don't. Or actually, in that case, it would be about 350 billion, I might have control. But
I mean, you have control in so much as you're buying those stocks versus some other stocks, right? If you were just offloading, if everybody was just offloading stocks of a given company, then you
but I
would.
have no control. Okay, so yeah, no, I mean, but
Yeah, I think that
most
you
shareholders
have
absolutely no control. I mean, you might
you
have votes in the
yeah. So how is this different? How is this categorically different from before though? Because it seems
Okay,
like if everybody's buying U.S. Steel and there's a
that's
million
always been the
shareholders,
case.
okay, so this is
Yes.
always the case. So when you own shares, you don't actually have any control.
So when the stock market became important, became liquid, it was because lots of people saw that and it was really only in the 1920s that the New York Stock Exchange, which emerged as the biggest stock exchange, became very, very liquid. And that's because it was dominated, a number of companies that were dominating in their industries had emerged. And then so if you take the case of General Motors, which became the leading automobile producer during the 1920s, surpassing Ford, which had previously been the leader. And if in 1920 it was a bunch of companies that had been pulled together by a guy named Durant, it wasn't clear that it was going to become a leader, but it did. It became a much better mass producer than Ford. It had all the whole line of cars from Chevrolets up to Cadillacs, etc., and annual model changes, whatever. And the closed car, they had all kinds of innovation in cars. Okay, they in 1924, if you were just sitting there, and it's sort of like now, I don't know if you know the chip company Nvidia. If I had been smart a year ago, I put a lot of money in Nvidia, I would have enough money to fund my research organization. People have seen that all the time after the fact. With people who have some money to put in the stock market, and they saw this with General Motors in 1924, and then they start speculating on the stock. And then you go and you're speculating on the stock through the last half of the 1920s. It's just that and other companies. The market's very liquid. You can buy and sell easily. You can borrow money on margin. You can borrow money for 5% of what you need to buy the stock and buy the stock. The market becomes hugely speculative. Then it outruns its ability to support that speculation, and it crashes. I like what's called, I don't know the origins of it, but it's called the greater fool theory. There's a lot of people who know a lot about the stock market, who know that it's going to crash eventually, but they think there's a greater fool out there who's going to buy the stock at a higher price, and the greatest fools are the ones who lose out. Okay. But we know that, the market crashed in October of 1929. It didn't crash because those companies were weak. In fact, they were what's called blue chip stocks. I don't know if you've heard that term, blue chip company.
I have, but I've just kind of always assumed that it just means, that they're actually producing something that if you do your due diligence, like they're a good investment.
They're good, yeah. So you refer to a blue chip stock are the best stocks you can buy on the stock market. Okay, that term started being used in the late 1920s. And the origins of the term is the blue chip is the most valuable chip in a gambling casino.
I had no idea.
Yeah. So people understood on on Wall Street that it was a gamble because the stock market was just speculation was building on speculation. And actually, you've probably heard of the economist John Kenneth Galbraith, who was very well known in the 60s and 70s. Mm-hmm. He did actually one of the more useful pieces of research he did was a book called The Great Crash. It was on 1929, where he said that the people who really knew that there could be a crash were the people on the inside, but they weren't going to say anything about it. They were either going to try to get out before they could, and they didn't want to be seen as being responsible for the crash. But basically, the stock market had become too liquid, too speculative. Okay, but the companies underlying it were very strong. In fact, in the late 1920s, and here's the relationship between finance and industry that probably someone like Randy Ray doesn't look at. Okay, the companies had huge surpluses, profits that they weren't, they were paying higher dividends to their workers. They were paying a higher dividend to shareholders. They're paying higher wages to workers, giving their workers more employment stability. This was without unions, but they still had lots of money. So they lent the money on the New York call market, which was the market where people could pay 11 or 12% and borrow money to buy stocks, just putting down 5% of the cost of the shares. And it was a safe bet because as soon as the stock fell by 5%, the money would be called in. That was because it's called the call market. The lenders would get paid back. So it wasn't really risky, but there was a big demand for the money. The corporations had the money, and they were putting it through Wall Street into the hands of speculators to speculate on their stock. At the same time, those corporations were selling stocks. A lot of what I do now is corporations that have a lot of profit buying stocks with their profits to try to boost their stock. But they were selling stocks to pay off their debt, put it in the corporate treasury. Now, they didn't know that a great crash was coming or the extent of the depression. But in fact, going into the 1930s, those corporations were in much better financial condition than they would have been because they took advantage of the speculation, both to make money off the speculation by lending money and to sell their shares to the speculators and pay off their debt, put it in the corporate treasury. So
Is that similar in some ways to the stock buybacks with just one less mediating step? Because if you're selling,
it's
if
a
you're
total opposite. Because what companies would be doing now is selling the shares on the stock market at the high prices. Buying the shares on the market, the stock buybacks at high prices.
But before they would give the money to the speculators, and then the speculators would buy their stocks.
Yeah, but they weren't giving the money away. I mean, now they're giving the money away. They're just buying the shares. The speculators owe them the money, okay, and they get the money back, and they're making 12% on whatever is being borrowed, and their principal is fairly secure, is quite secure because they have the as soon as the stock market goes down, the money comes back to them. And that's why when the stock market started falling very quickly, everybody had to sell, and it went down even further. But the corporations actually use the financial system to their benefit, not to the benefit of the executive, but to the benefit of the corporate treasury and having money in the corporations, that they actually were able to withstand the first years of the Depression better than they would have been able to otherwise. Now, ultimately, for reasons not having to do with those corporations, initially having to do with small business, the banking system, leaving farmers in the lurch, etc., the economy kept going down in the 30s. And around 1933, 32, 33, the big companies, they saw that there's no demand for cars or washing machines or whatever out there. So they started cutting their blue collar labor forces. That drove the Depression even deeper. That led to mass unionization, led to other outcomes, led to the rise of the New Deal in a very particular context. But it wasn't because the people running those companies were looting those companies. Just the opposite. They were actually using the stock market in an era of speculation. And it was one of the few times when companies really went and used the stock market to raise money, is that they didn't even need the money. But they were getting themselves in a better financial position because they saw these speculators out there. That's totally opposite from what Apple is doing now. Apple had $94 billion in profits last year, did $95 billion in buybacks. Okay, they didn't go out and sell shares and pay their workers more, and with the proceeds, they bought shares. And we see all over the companies buying shares, tech companies profitable, and laying off tens of thousands of workers. It's a totally different environment, and that's in a boom.
Sure. Hold on. I think Shiloh wants to ask something.
I mean, I don't. You can hold off on the buybacks thing, but I don't understand why they're doing that. But maybe
why they're doing buybacks?
Yeah, because you said that the shares don't lead to control, so I'm curious.
Pardon the interruption, but I have a favor to ask you. If you are enjoying this podcast, consider coming over to patreon.com and supporting us with a small monthly donation. We cannot make this show go without you. We want to forever maintain it without sponsors or advertisements, and so we rely on you, dear listener, to help us. So come on over to patreon.com/demystifysci and help us power the ship.
Okay, yeah, so we can follow this through in the relationship between the stock market and these companies. So where I left it, I wouldn't place too much emphasis on the fact that they were lending money to speculators. They were doing that. Some of the companies that had lots of money, but they were also the one time when you see a real spike in stock issues is in the late 1920s, when they're taking advantage of a booming stock market to sell shares to the speculators. But what they're doing with that money, most of these companies that are not, they've already used their profits to invest in plant and equipment. A lot of them are using it just to pay off debt, to have cash on hand, because they're looking forward to, next year, the year after. Again, they don't know that a depression's coming, but a depression comes. Now, into the depression, the stock market was dormant. Basically, it was not. There was people, dealers and brokers on New York Stock Exchange were not making lots of money. There was also, by the way, lots of small dealers all around the country who were doing what was called over-the-counter trading. Let me just give you a little bit of background on that. A company often would, when it first issued its stock, would not go right on the New York Stock Exchange. There was no NASDAQ at that point. That comes in after 1971. They would often have some dealer, a local dealer in stocks and bonds, who would have advertisements. You can see them if you go in the historical Wall Street Journal and New York Times, and say, we have a stock of IBM that we're selling if you want to buy it. And that was on the over-the-counter market. So actually the company that was originally IBM, called Computer Tabulating Recording Company, which was founded in 1911, issued stock on the over-the-counter market. And often that stock was issued because people who were shareholders wanted to cash out, and this allowed them to do that. Okay. At some point, some of those companies could graduate to the New York Stock Exchange, which was called the Big Board, where you had to have more of a track record of profitability, of a certain amount of capitalization, a certain number of shareholders to be listed on the New York Stock Exchange. I mean, the New York Stock Exchange is just a bunch of white men deciding a set of rules, and this is the rules they decided. And the New York Stock Exchange became the place where you had more stringent listing requirements, so there was ostensibly better companies, but again, some of them, even the best ones, were called blue chip companies after the gambling casino.
Quick question.
Yeah.
This counter sale of stocks, where you have this kind of tiered system, is that still in existence, or now it's stock exchange or no exchange?
That became NASDAQ. I'll get to that.
Got it.
So NASDAQ until about 1988. When they actually started trading stocks on NASDAQ rather than just listing them, it was called the over-the-counter market, but it was internetworked with computers. I'll come to that. Okay, so...
by the way, when you say it was like white men, do you mean that they weren't doing stock exchanges in Asia and other
No, I'm just saying that in the United States, there were stock exchanges other places. I just said in the United States, there is an elite. There are people who were just... this was not like this became a national institution, but it was people who were just making a set of rules about what companies could list, and they would bend the rules sometimes, it was, they, for example, in around 1927, they said that if you had stock listed on the New York Stock Exchange, the common shares had to have votes. Okay, that hadn't been required before. And it often hadn't been the case. Now it's typical, not always the case, but it's typically the case that common shares, if you buy shares, you have a vote. Okay, they made that rule because there had been an attack on Wall Street by a Harvard professor, and who named William Ripley, who and they were responding. They wanted to restore confidence in the stock market, but actually they knew by that time that shareholding in the 1920s, from the beginning of the 1920s, became very widely distributed. And they knew that, in fact, the votes didn't really matter in terms of the companies, because the people on the New York Stock Exchange, they understood that it was the companies reinvesting their money that was actually good for the New York Stock Exchange. So buybacks were not done, not because they were illegal, but because companies were trying to grow, and the New York Stock Exchange had a set of rules that said we want companies that grow, that reinvest, that are generating more profits, and that are basically able to compete on the markets. Okay, so that was the situation in the 1930s. The 1930s, the more important changes were the rise of mass unionization in a lot of these companies. The mass unionization was actually, the way it actually turned out was in a way that the companies could benefit from, and that is, the unions did not have any control over what was going on in the companies. They just bargained over wages and benefits, and what they got was stability of the labor force. The big, the fundamental principle of U.S. mass production unionism, which came out of the New Deal and was made possible by the National Labor Relations Act under Roosevelt, was that the principle of seniority, first hired, last fired. But that's actually in the 1920s something that companies that were mass producing wanted, because they wanted a stable labor force. Labor force that came and went, it screwed up productivity. They caused problems on the production line, sometimes deliberately, sometimes not deliberately. But basically, you had this big blue collar labor force that was separated from management. There was actually a bit of a battle around the end of World War II about who could be in unions. The four people were the foremen, who actually came out of the blue collar labor force but were supervising workers, tried to organize their own union called the Foremen's Union of America. The National Labor Relations Board ruled that they were members of management, not members of labor, and therefore they could not unionize, even though they were actually in positions, or they didn't move into management from then. They were just shop floor supervisors. So there was this division. It becomes very important later on, particularly with Japanese competition within companies between the white collar workers and the blue collar workers. It also shows up in the National Fair Standards Act of 1938, which put rules about overtime pay. So you probably know that many people, particularly if they're in unions, if they overtime, they get paid time and a half. Okay. That comes out of the National Labor Relations Act of 1938, which said that certain people had, at that point, it could not, if they worked more than 40 hours a week, they had to get paid overtime. Okay. That exempted people who were on salaries. Okay. So within the language of that act, the exempt workers are people who are exempt from that. They would include these foremen. They would include the people who were engineers, and all the people in the white collar labor force who increasingly became college educated people in the 50s and 60s. Okay, so there's this division between hourly workers and salary workers. Now, the hourly workers actually they got paid an hourly wage, but they often had more secure jobs than the salaried workers. But they had, when the unions, they had the protection of seniority. So when there was layoffs, it would be the most junior workers who were laid off first, and the senior workers stay there, and they were also able to bargain for not just wages but for benefits, like the companies giving them defined benefit pensions.
It's funny, like, I want to just comment that I think many of the people listening to this, including people in this room, have all lived through this, right? We've all, I don't know all, but many of us started out with blue collar jobs. And the first time that we got a white collar job with benefits and with a salary, it was like, holy crap, this is super chill. Actually, we were just talking about this morning, just how insanely, what's that, desirable it is. I teach at the university, and my students are all ostensibly in university because they want that white collar job, because they're terrified of the blue collar situation, which is a real grind.
But the white collar
and
jobs
insecure
are
too. It's actually it's the opposite today from what
but
sounds like
you
what
won't
you're saying.
find. Okay, I'm sitting here running a nonprofit because actually without having to worry about my own pay, because I'm retired from the University of Massachusetts. I was a government employee. I was originally at Harvard and Columbia, but then I decided to go to the UMass in around 1993. It wasn't really in my thinking at the time, but it turned out from a point of view of long-term income, it was a really good move because I got a defined benefit pension. And which I get a stable amount as long as I live every month based on my years of service. And that came out of industry. Companies started giving that to their white collar employees even as early in the 1910s and 1920s because they didn't want them to go to other companies. You don't have that anymore. You have 401ks, right? Okay. Blue collar workers then bargained for that. They also bargained for healthcare benefits. One of the reasons we have such a problem with the healthcare system in this country is because these dominant corporations of the post-World War II period, they were giving all their employees, blue collar, white collar, health medical coverage, both when they were working and in retirement. So, and they were the people that mattered. And again, it was mainly white men who were getting this. I'll come to that because it's important when it starts breaking down, and African Americans, I have a book coming out on this, start getting access to those good blue collar jobs, unionized jobs, the whole system starts breaking down. But not necessarily just for that reason, but in part for that reason. But basically, so it was a world of that they were providing post-World War II period, particularly the 1950s would be really the peak of it, but into the 1960s and beyond, of basically privilege, upward mobility, being a blue collar worker. You could earn an income that would get you a lower middle class, even a middle class existence, and also your children would be able to go to college, often for free if they went to a state college, because state colleges were free. That came out of the Land Grant College Act began in 1862. But basically, this is where the middle class came from. The middle class didn't come from a central bank deciding to do this or that. It came from these companies offering these jobs. I call it a CWOC, a career with one company. It was the norm. And no one said that if you employed, well, with blue collar workers, there were some restrictions because if you're unionized, there was a seniority principle. White collar workers, nobody said that you cannot lay senior people off, but they didn't, at least until they started to do so. And IBM, I'll get to that story in the early 90s, is really the company that changed the game. General Electric did it to some extent in the 1980s. But basically back then, these people had secure jobs, and the defined benefit pension was a manifestation of that because it basically was non-portable. You couldn't take it to another company. It was dependent on years of services, so it was encouraging you to stay at the company for as long as you could. And after 30 years, you would get a very nice retirement pension. It was totally the big companies funded by the companies. And so the companies then were taking that money and trying to get yields on it, and they were actually putting it in the stock market to get yields to pay the pension, okay, which was mainly coming from dividends or what they saw the stock capital gains. Okay, the stock market in this period was there mainly for one function, and that was to separate ownership from control. It didn't have the other functions are the four other functions the stock market can play. One we talked about is what I call creation. It can actually induce someone who has private money, like a venture capitalist, to put money into a company because they know that that money is not tied up forever. And if they can do a public offering on the stock market, they can get the money back. That becomes very important to the rise of Silicon Valley, what I call the new economy business model, which starts really taking off in the 1970s and 80s. The other thing that you can do with the stock market is you can raise money, but actually that, with some exceptions, which I can get into, is not very important or hasn't been very important historically. Uh, uh, I'll just give you one little anecdote from a recent paper where we're criticizing the CEO of Merck in a paper on the pharmaceutical industry for saying that they have to do all these dividends and buybacks because their shareholders demand it. And we show that this is recently, the last time Merck went to the stock market to get money was 1952. So they don't need to go to the stock market to get money. They're doing it just to get the stock price up. Okay, that's generally been true in the 20th. Was generally true in the 20th century for American companies. Okay, they could also use it to buy other companies. That became very important again from the 80s and 90s, and they can use it to pay their employees stock options. Okay, that's a whole other issue that we'll come into, but that becomes very important really only in the 80s and 90s and beyond. Okay. Back in the 1950s and 60s, the function of the stock market was just to separate ownership from control. I'll give you one example, which is a good one. Because Hewlett Packard, which was in the heart of Silicon Valley, started by David Hewlett and William Hewlett and David Packard in 1938 or 9. Okay, they grew very slowly, but by about 1955, a lot of their production was done during World War II for the military, but then they were producing diagnostic equipment for the growing electronics industry. They were at about 5,000 employees, and they decided they were privately held, most of the stock held by Hewlett and Packard and some other people who might have given stock to. They decided to go public on the stock market, and they listed on the over-the-counter market. And they did it in their annual report. It said it was for estate planning. Hewlett and Packard wanted to take some money out of the successful company that they had built up. And so they were putting this money into the hands of some dealers who were trying to sell it, but it wasn't a very liquid market. That was 1955. 1961, they went on the New York Stock Exchange because the restriction was they were very profitable. They had a lot of market capitalization, but they didn't have enough shareholders. By 1961, they had enough shareholders to meet the listing requirements of the New York Stock Exchange. So now they were on a more liquid market. It not even mentioned, for one thing, in their annual reports. It's not a big deal. The stock market was not important for them other than for Hewlett and Packard to be able to sell their shares more easily and get some money out at a higher price. They started giving maybe some people at the top of the company some stock options. That was enabled by the Revenue Act of 1950, that you could give options to people, but to your top management was mainly, but it was mainly a tax dodge. They could get a 25% capital gains tax rate rather than have to pay the ordinary tax rate, which could be as high on marginal taxes of 91%. That was actually something that Congress ended starting about 1965, and definitively by 1976, they got rid of that tax dodge. Interestingly enough, the person who was behind that in the Senate was Albert Gore Sr., Al Gore's father, who wrote an article, a very influential article in the New York Times in 1965 called "How to Get Rich Without Paying Taxes," and it was criticizing the executives getting this capital gains tax dodge on their stock options. But my point here is that the stock market had a very limited role. Okay, most of the shareholders were not institutions, but households. They were called, which we call retail shareholders, you and me. And they had votes, but they didn't have much power. Now, there were some people who would try to aggregate the votes and have a proxy battle to get control of the company, but it was very difficult, very expensive, unless the company wanted to do it. Now, what happened in the 1960s is that some companies actually got control as managers who wanted to make money just out of buying and selling companies and doing deals. And you get the conglomerate movement. And you get companies that are just buying other companies, often selling other companies, using debt to buy the companies. And you get for the first time, but this is actually not coming from the stock market, it's just coming from the companies themselves, the ones who, well, if their stock is higher, it's easier to acquire the other companies, but they are getting control of these companies and building these conglomerates with a bunch of unrelated businesses. Now, basically, in the 1970s, the conglomerates fail because if you're one of the people trying to run those businesses in the conglomerate, generally, the people at the top don't know what it is you need in terms of finance, what it is you need in terms of investment in new technology. There's a disconnect between top management and the people who are really, really running the companies. And that actually starts falling apart in the 70s and 80s. It leads to things like, which I can get into, the junk bond market, the rise of, you've heard of Michael Milken, perhaps, the king of the junk bond market, who ended up getting thrown in jail by Rudy Giuliani in the late 1980s. That becomes part of the sordid history of the decline of the conglomerate movement. But basically, that was really the beginning of what I would call corporate financialization, which is coming in the 1960s of just buying companies and getting control of companies to sell them. So
okay,
you
so
have
let's take this apart really quick, because I think that this is really interesting. I think that this is something that everybody recognizes as being a feature of the landscape right now, which is this jockeying for I guess the ownership of intellectual capital. Like I feel like there's a lot of mergers going on. There's a lot of corporate raiding. There's a lot of just the big companies. Like I know a lot of people in Silicon Valley, and for decades now, the strategy has always been to create something that then gets bought up by a Google or an Apple or a Facebook. And so
Sure.
clearly this is a thing. But you say that the corporatism and this kind of conglomeration had a crisis in the 1970s, but I look at the landscape right now and that doesn't register with what I see, which is that, Mondelez International owns basically every single food brand that you see in the grocery store. There's like 7 corporations that own all of the major news networks. There seems to be just a very small number of huge corporations that own these giant stacks of tech companies. So is it something that dies in the 70s and then comes back full force, or what? Because 1971 seems to be a really pivotal year for a lot of people.
It's also the gold standard year, right?
Yeah. So it's like, what is happening in 1970, specifically in 1971, that seems to change fundamentally what the economy looks like and how people feel their role in it is satisfying or not satisfying?
Yeah. Okay. So to some extent, conglomeration has come back, but it's somewhat different forms. It tends to be more concentrated in particular industries, but it did come back with someone like Jack Welch at General Electric. I mean, General Electric actually in the 1950s and 60s became a conglomerate. Is one of the big companies that became a conglomerate from within. Most of the other conglomerates were outsiders coming in and getting control, and then turning the conglomerates. But basically, let me get to how it changes, because certainly there is, if you have a lot of, if you have money and if you have shares in a successful company, you can buy other companies. You can turn them into bigger companies, but you often have people having dominant roles in a lot of separate companies. Elon Musk, who you study very closely and is worth studying closely. I mean, he's now dominant role in 6 companies. He's a lot richer having a dominant role in 6 countries than if he turned them into one company. He doesn't need to turn them into one company. Because each of those 6 companies can go public on the stock market, make him a huge amount of money. So
this
at
seems
this
like a
point,
really unusual paradigm, right? Because like Carnegie was the owner of a single vertically integrated company that had lots of different
yeah,
branches that did a thing, and so there's a weird or like the Standard Oil guys. Again, it's like a
yeah,
vertically integrated organization that does a lot of different things, and so this
yeah.
approach of having one guy who's running a bunch of different companies
Well, but yeah.
is that a way of just getting around antitrust
Mm,
regulations, or is it? Because I mean, wouldn't it
nah.
be easier to just bundle everything together? Like
Yeah, to some
cars and
extent, yeah,
space and
yeah,
everything else seems kind of related.
yeah. To some extent, well, the conglomerate movement of the '60s really didn't have much to do with that. It had mainly to do with outsiders, basically coming in to the corporation. What I mean is that they were not managers who were going up through the ranks, but they were able to use the fact that the companies were publicly listed, get access to enough shares to get control of the companies, and then use them as vehicles to buy and sell other companies.
And so,
Now,
who are these people? They're just
Yeah.
rich people that want to own companies.
no, they were often aggressive people who were on Wall Street and saw this opportunity if they could get control of the companies. The reason it broke down, and this is pretty well documented, is because these companies were producing a lot of things, and you need to have what I call the integration of strategy and learning, or strategy and organization. The people who were making the strategy had no idea what was going on in the companies, and they didn't really care. They were,
Mm.
it was often called managing by the numbers, or it came out of a really out of a training school that General Electric had. General Electric is a peculiar company because it's a company that had all kinds of technology in it going back to the 19th century: power systems, medical equipment, then from World War II, airplane engines. But in the 50s, one of the things that General Electric also was into was appliances.
Mm.
They got into that around the late 1920s because they were making so much money out of light bulbs. They're paying their workers better. They were paying dividends to their shareholders, and they said, "What else can we go into?" They said, "We're in electricity. We're going to appliances." Appliances was not a high tech field. It was a mass production field. And when they went into appliances, they brought in a whole different type of worker, semi-skilled unionized worker. They brought in a whole different type of managers, admin, basically. And in 1945 to 1960, General Electric was run by a guy named Ralph Cordner, who was from Schick Razor, running a company that was the leading technology company probably in the world at the time, with jet engines, gas turbine, power systems, medical equipment, etc. And basically, they started teaching. They had uh, in Hudson Valley. They had Hudson River somewhere. Crotonville was called. They had a school for managers. A good manager can manage everything, and they started teaching that in business schools. And recently, I met a guy who built up a company from the 1970s into a really successful company, who had worked actually not for GE but for Westinghouse, which was GE's competitor. And in 1968, he was doing respiratory equipment in General Electric in Westinghouse. He said he quit Westinghouse because he got a guy who was his boss, who said a good manager can manage anything. I don't need to know what you're doing. Basically, we'll just manage by the numbers. So this was starting to come into companies. You cannot run companies that way.
Okay, so
Uh,
let's see if we can like
yeah,
put a handle on this, because
yeah,
this is a lot
yeah.
of
Okay,
ideas. So basically, what you're
yeah,
saying is that there was a way that firms were organized through the 1960s and 70s, which is that the stock market was kind of incidental to the fact that the firm that was successful existed as a continuously flowing entity where there was continuity of culture and expertise, where
that's right.
people that were working there for a long time. And this is what creates the middle class, because you have people that are protected by the labor unions on one side. And so you have this like first in, last out mechanism that makes sure that people that are good at what they do stay there for a long time and are able to weather these economic upturns and downturns. And then,
So, Salaried people are protected by the pension structure in a
Yeah,
similar way.
and you didn't hire and fire. I mean, you could, but if you started to do that, Jack Welch started to do that
Yeah.
in the 1980s. And once you
Okay, so
start
hold on.
doing that,
Let me finish this. Let me finish
yeah,
the summary.
yeah,
So, everybody, you have a really successful middle class, and then all of the sudden, in the 60s and 70s, it almost seems like what you're saying, that companies, there was so much money in this financial market that people who were interested in being like a meta layer of business, where they would come in and they would agglomerate all of these different companies and then manage them to make money, were starting to come to the forefront, but they weren't able to actually handle the conglomerates that they were creating because they were operating under this bottom line metrics. Numbers are the only thing that matters, and you actually can't run a successful company on the basis of numbers being the only thing that matters. And so these people were taking companies over, destroying them, and then creating massive downstream
yeah.
consequences.
And
yeah.
why can't you run a company by the numbers? We didn't really
Why?
explain
Okay,
that.
okay. Because all right.
I mean, it
Yeah,
seems
okay.
logical enough.
No. But this is actually absolutely essential. Because how do you get higher productivity? You don't just get it by taking a machine and putting it inside some walls and running it. Okay. Everybody can do that. You get it by people actually improving the way the product is produced, the way the process works. And so that's learning. Okay. Now we get a lot of education.
People have to really care, right? So there's a thing where it's like, if you're working at a company and
Yeah.
they've got a machine inside of a room and you don't really care about the company doesn't really care about you, you're
Yeah.
going to go home and you're going to spend your time and effort doing something that isn't making the machine better. But if
Yeah.
you have this like back and forth relationship, then
Yeah.
productivity gets better because you've got
Yeah.
some tinkerer who's like, well, hey, hold on a second. If we like make this adjustment, all of a sudden we can make things better. And that kind of passion and commitment,
Yeah.
I think, is kind of gone by the wayside, even for companies where people get paid really well. Like, we know a lot of tech workers, and there's some tech workers that are really invested in like making better tech, but a lot of them are just, I'm making six figures, high
Yeah.
six figures. Let's party.
Yeah. So I think it may be the tinkerer, but I think where the companies are really, I call it collective and cumulative learning. You go to work and there's a lot of people who know what they're doing. There's a lot of internal knowledge that you can draw on. You know who to trust, who not to trust. There's certain protocols that you follow, and you can get things done that you couldn't get done on your own, and you couldn't get done in an organization which is just saying, you just make out for yourself and screw everybody else over, and that often happens, or do as little as possible and let everybody else do all the work. Okay, I think that the uh, secret to it, any innovative company, is to have a core of people, and often it's a large core of people who are consistently doing their work and can be relied upon. And sometimes those people may be people that at any point in time you could say, okay, I could easily replace this person with someone else, give them a week of training, but at that point in time, there could be someone who is just has a job that's not too difficult to learn, but if they don't give you the right information, or if they don't, you know, just have their input into the system, if they withhold some of the knowledge, they the whole thing can grind to a stop. So you have to have people who are coming in there every day and doing work, and that will get translated into some kind of commitment to doing work. The work becomes less of a burden, more enjoyable, more people identify more with it. Okay. If a company can get that, it's going to be a lot more productive than a company that's just trying to squeeze wages, just trying to have supervisors, try to get people to work harder, set one person off against the other. That's a fundamental thesis, which is not an economic thesis, really a sociological, psychological thesis. But that's the corporations are huge social organizations, and when I was teaching this stuff, I would say, okay, to these usually freshmen, if you can start a company and you can, for 10 years, employ 10 people and pay them decent wages because you're able to sell a product, which is the only way you can do that, you're going to become reasonably wealthy, even with 10 people for 10 year 10. Not like a millionaire maybe, but you're going to make money, because if you can run a company where you're employing people, those people come to work, even if they're coming to work for $40,000 a year. If they don't do any work, you're losing 40,000 or 20,000 or whatever you're losing per year. You have to get a profit. Okay. Now, and if you reinvest that profit, pay them higher wages, get them to see that identify with the company, you can have a very successful company. And I could give you examples of companies like this. But I would say examples that I know, because this is actually a very hard thing to actually see from the outside. But that is the way companies are successful. There is more than that, than people just shirking, people just saying, okay, I'll take my salary. What recently they started calling quiet quitting, or etc. In the union world, blue collar world, they would call it work to rule. That you only do what you're supposed to do. You don't do anything else. Feather bedding. There's all kinds of things. Restriction of output. These are things that when you had a lot of mass production workers, less automation, this was really, really important. You could have the downtime of all your expensive machinery if the workers didn't work. But it's true also, anything that requires productivity improvement, whether it's marketing or engineering, is going to require this kind of learning. And the companies that have this learning in place are the ones that are going to be successful and start making profits.
Okay, so if we take that to be the case, then what happens around 1970 that dramatically undermines this as being the foundation for all of the wealth and prosperity in this country?
Okay.
And why does it take so long for people to notice?
Okay, so there's a couple technological revolutions that which are critical to and the most critical one is the microelectronics revolution. And that comes out of AT&T, Bell Labs. It was the case that Bell Labs, because AT&T was a regulated monopoly, they were required to share the transistor, which was the invention in 1947, with the rest of the world, basically. And so they had a seminar in 1951 where you could license a transistor for $25,000, any company. First for U.S. companies, in 1952 for foreign companies, and the Japanese were all over it. And you now had the microelectronics revolution, which companies that were in the forefront of this were Motorola and Texas Instruments, and you end up getting the silicon chip. Okay, that's in basically 1958, 1959, you get the integrated circuit being developed at Texas Instruments and at Fairchild Semiconductor. Okay, that leads to the whole growth of Silicon Valley, the spin-off of firms, the startup of firms, and it turns out that the big companies were all investing in semiconductors in the microelectronics revolution, but the successful companies were startups, okay? Because there was so much that was unknown about that technology, and so many uses potentially for the technology, that the learning had to be very, very focused. Okay? And so that was a much better model for learning about a wholly new technology. And companies like, there was a company, Sylvania, Ford, Hewlett Packard itself, which was right in the heart of Silicon Valley, did not succeed with its chips. People kept leaving to go to the startups. Okay, now when they left to go, and this took about 2 decades to unfold. When people started leaving to go to startups, this created a problem for the companies because they were offering the secure employment and now people were leaving, but people couldn't get the secure employment with the startups.
So people are walking out on their pension structures with the sort of like Wild West hope of striking gold.
Not everybody, but some people are. And okay, now.
By the way, why are the startups so much more successful at this? Just because they can explore lots of I guess on balance they're not successful. Like they, as en masse, can explore a lot of different possibilities, and some of them it'll work out for, some of them it won't work out for.
I personally think that this has to have something to do with the technological transition, right? If you have companies that are somehow structured prior to the invention of the microprocessor that are then trying to get into the microprocessor game, they have a foundationally different culture than those that are born of the microprocessor game to begin with. And so you see this all the time where a corporation that exists for a relatively long period of time and then tries to make their name in some new market or some new technology, they kind of suck at it. Like they don't really understand it. Like the people that run it are kind of old. They're stuck in their ways. They're not nimble. It's the ideas that are coming up from the engineering floor are in conflict with management. And startup culture doesn't have any of that. Startup culture is just kind of,
But a lot of startups fail too, is my point.
Yeah, absolutely.
And you just don't hear about it.
The other thing is that, the learning, although it's going on in firms, it's no longer proprietary in the same way because people are leaving, people are going from one place to another. And so that there's a certain amount of knowledge that's accumulating. So as someone who really knows the biotech industry, I study it, but knows it from the technology side, explained to me, basically, if you are trying to target a certain disease and use a certain molecules and etc., and at one point in time, you're trying to do a startup, but the learning is really just beginning. Okay, it's going on in labs and universities and NIH labs and in various places and to some extent in companies. But those people are leaving and, there's some stuff is patented, but some is not. Those startups aren't going to be the ones that succeed. It's going to be later on when there's enough accumulation of knowledge and whoever can get control of that knowledge can then get at least have the credibility of getting a product to market that you succeed. I mean, biotech is interesting because you actually can do it. Almost all biotech companies do initial public offerings without a product, on speculation. But
this is really interesting because there's something about the university system as being the place where a foundational base of knowledge is much more centered than it was prior to the 1960s and 70s, right? Because if you have a system where somebody goes to work at a company and then works at that company for the next 30 or 40 years, that, like you said, that proprietary knowledge accumulates within that company in a way that makes them really rich. If you have all of a sudden this new field, then what happens is you have to get people to go to college and get trained in the most basic set of knowledge so that you can accumulate this advantage faster. And I feel like this might I've never thought about the relationship of the emergence of Silicon Valley and high tech as being somehow related to the rising necessity of a college education, but I think that they might be because of this aspect of proprietary knowledge.
Absolutely.
Do you follow?
Okay. Yeah. Let me take
Shiloh's shaking his head. Hold on. I want to make sure that I make the point where I'm like, look, if you have to, if you learn a bunch of stuff in school, let's say you finish like through grade 12, you have some set of basic knowledge.
You're basically saying that the university structure replaces the firm as educating its people across some sort of initiation scheme?
Yes,
I think that's better said. Definitely.
Okay. Yeah, I got it.
Well, I think that's partially true, but let me give a add to that. Okay. University education, if you're going into science, engineering becomes, that actually goes back to the early 20th century. By the 1920s, companies are recruiting people for technology from MIT and Purdue and other engineering universities. That becomes really important. and they're actually helping. Many of the companies are actually helping to shape the curricula of the universities as well. So that and it's not at that point. It's not generally for very specific knowledge, but so that people generally understand the field, and they understand the field in a way that they can apply it. They can to industry when they go out. But what then becomes critical is the learning you get from experience, and that would be part of this collective and cumulative learning process, and being on the inside of that, and being able to grow with that, and often being able to succeed in that. You might grow up the hierarchy, supervise other people, train other people. You'll be in various positions within that. Okay, but what happens with the rise of Silicon Valley, and let's stick with the microelectronics revolution, is that they didn't know how to produce these things. They didn't, they're finding all kinds of new uses for them. So when Intel was started in 1968, and of course, Intel's now in big trouble, but when it was started in 1968, it actually said, we're not going to have an R&D department because that's what we do. Okay. We are not, they also said, we're not going to have a goal of not producing for the government because there's too many new uses for chips. It was memory chips. By 1971, they actually produced a computer on a chip, the microprocessor. They did it because they had a contract from a Japanese calculator company that then actually turned out they didn't want to take it, and so they bought it back. And that became the foundation by 1974 of their microprocessor business. There wasn't much going on there. It was really memory chips. Okay. Now, but Intel, the people who founded Intel were people who were Noyce and Moore, Gordon Moore and Robert Noyce, and then brought in, the third one was Andy Grove. They were right on the ground floor of this. They had come into an industry where they knew about the technology. Noyce had been one of the inventors of the integrated circuit in 1959, but they didn't know how to produce. They had to learn how to produce them. And the companies that learned this best were the companies that succeeded and then moved into other types of product markets which were related. Now, an interesting thing about Intel is that they thought, because the Japanese were producing all these digital watches in the 1970s, they thought, oh, we produce chips, we can produce digital watches. They tried to get into that business, totally failed. I think Gordon Moore is the one who said that he was wearing a digital watch from Intel that cost them $1 million or something, because they could never scale these things. So they actually tried to often vertically forward integrate into other markets. They were good at doing what they were doing. And actually, in the case of Intel, when the Japanese got better at producing memory chips, which then became known as commodity chips because they were being mass produced, the Japanese were better because they were much better at getting rid of defects in the production process rather than the design. Intel had an advantage in design. That had a lot to do with the nature of production workers in Japan versus the United States, which is an important story, but that was part of the shift. But Intel almost went bankrupt in 1985 because it was losing the memory chip market, but it had the microprocessor market. Okay, not only had a microprocessor market, it had the IBM franchise. Okay, now here you get these, what I call old economy, new economy coming together. Because by the late 1970s, IBM is the epitome of the old economy company. It brags that it never had laid off anybody since 1921. I've seen that written various places. It didn't lay off anybody during the 1930s. In part, that was because it was producing machinery for the business machinery for the New Deal. But also there's an excellent book called IBM and the Holocaust. They're also producing the Hollerith card sorting machines for the Nazis. That's a whole other story. So they were global, but they were dominating. They were the biggest computer company, biggest chip maker, biggest software producer, but it was all for themselves. So it was totally a proprietary system. Okay, and so what IBM produced, they wanted, now this is very important, they wanted people who they stayed there for a career. because those people became the trainers, the systems integrators of the proprietary system. Okay. And that was IBM's model. But they saw the personal computer come along. And that was in 1980. They said, we got to get into this market. They were smart enough to say that we cannot do this within the integrated structure of IBM. We're not going to buy the chips from ourselves. We're not going to buy the operating system from ourselves. They created in Boca Raton, Florida, a skunk works, they called it. And they said, they said, produce us a what became known as a personal computer. They did it within a year. Okay, they did it, first of all, by contracting with Intel to produce the microprocessor. Intel already had business, but this got Intel the microprocessor market and meant that in 1985, that was their growth market, and that's what kept them going when they lost the memory chip.
Why'd they call it Skunkworks?
Well, I don't know where that came from. It wasn't IBM's own, but it was basically a notion of this is a kind of.
I know the story of this.
Okay.
So Lockheed Martin had a division where everybody was tasked to work very, very fast without the constraints of a conventional management chain. And that branch of the company was headquartered next to either like a paper factory or like a manure refinery or something that smelled disgusting.
Okay.
But so Lockheed Martin established this during the programs where they were building the bombers, and it was so successful because they built some of their bombers. I think, like you were saying, IBM built the personal computer within a year. And so other companies then began to open up their own skunk works projects in order to be able to get away from this really drudgerous management chain. And so
It just means like a satellite, like offshoot?
It means like an anti-bureaucratic, like go fast and break stuff branch of the company that has a single goal and is not constrained by top-down management decisions and chain of command. And it's usually like the best engineers that are taken from the company, given a lot of money, a lot of leeway, and just told like, make it happen. And that's Skunk Works.
It's using it's a startup model within the company, but without being beholden to all the protocols of the company and all the rules. And their hiring is different, and they didn't have to use the company's technology if they didn't want to. And so that was the critical thing, because as the Wintel structure, what became known, the Microsoft, the Windows Intel structure, which created the standards for the computer industry and the digital revolution, that IBM created that. They actually, for the operating system, they heard of this guy, I think his name Kildare, who was on the West Coast, who had an operating system they thought they could use. They went to visit him. The story goes that he was out flying his plane. His wife didn't know when he would be back. So they said, well, we can't wait around. They heard about this guy named Bill Gates up in Seattle. They went up there. Gates told them, oh, yeah, I have an operating system, and then went down the street somewhere and bought one for $25,000. And, then the rest is history. Basically, they got the IBM franchise. IBM did not try to say you cannot sell that to anybody else, to keep that proprietary. I think that was in part because of a fear of antitrust. They actually owned 12% of Intel at one point, then sold it off. But they also, I think, saw that that this was going to be a competitive industry, and IBM actually made a lot of money in the microcomputer industry throughout the 1980s. They led the industry, had all the clones, but they did fine with it. But then they changed between 1990 and 1994 dramatically, by basically getting rid of their lifetime employment quite deliberately. And now the reason they did that was because computers were getting more and more powerful. There were companies like Digital that were producing mini computers that were competing with the mainframes, and there were some Japanese companies doing this as well. So they decided that they didn't need a lot of these more experienced workers, but they were saddled with a lot of the more experienced workers. The other thing feeding into this was, well, the startups, a lot of those experienced workers, they were training them, they were going to the startups anyway. Okay. Now, the third thing that was fed into it, which really hit big in the last half of the 1980s, was that companies should be run for shareholders. And at a company like IBM, the impact of that was that this justifies laying off, as it turned out to be. They went from 374,000 people in 1990, the end of 1990, at which point they were saying IBM's never laid anybody off since 1921, or at least voluntarily. They would have people could retire early if they want. To 4 years later, they had 220,000 people, over 154,000 people net, because they were hiring new people as well. They laid off. And that was to get rid of the lifetime employment system they had. Okay, they then changed their pension systems. They wanted people with the new technology. Now, to some extent, you're right. They were learning that in university. Universities were now teaching computer languages, etc. But they were also learning it by going from company to company. And that was valuable knowledge for a company like IBM, if you could get them to land at IBM in an open system. So this is what a lot of people have written about, this open system architecture coming in. If you could be the dominant company in an open system architecture, you were going to leave. But that meant that you didn't need to have all this proprietary technology. Interestingly enough, at that point, IBM slashed its R&D. They started getting rid of their hardware. They over the 90s and into the 2000s, including their chip fabrication, I think it was in 2014 or 15. They got completely out of hardware, software and services, totally a shareholder value company. This guy, Sam Palmisano, came in the early 2000s. He was, and Gerstner, who was a guy they brought in from RJR Nabisco, or he'd been Americans, but they were totally run the companies to pump up share prices. That's all the company is about. And that's the game they played. They're still around. They're not an innovative company, but they're so big that they could sell their software and services around the world and survive. But they are a company that's when you get into the stock buybacks and just spending tens of billions of dollars a year just pumping up their stock price. And that's the way their CEOs were describing what the company does, particularly this guy Palmisano, who was there, I think maybe 2005, 2015 or something like that.
Where's that decision coming from? Is that like a board level decision? The valuation of stocks over anything else? Where's that driven by? Like, what's the heart of that?
Well, I think the heart of it is that I think to this day, in any company, there's a tension between what I call innovation and financialization. Are you going to build the company up, or are you going to tear it down? Okay. And both can go on at the same time if you're really an innovative company. So there's a term that I started using in the 90s, that a company that's geared toward investing toward the future, keeping its workers, I call retain and reinvest company. It doesn't mean that it doesn't pay out anything to shareholders, but it generally will pay dividends. Usually about 50% of its profits will go to dividends, and the rest will go into the companies. And actually, if you look at old annual reports, I mean, going back 70s and before, that's what the companies will say. They'll say, we paid out this money to shareholders, the rest went for reinvestment in the companies. But it's not buybacks, just dividends. Okay. The ideology that you should run companies for shareholders, that came really, first of all, it came out of the Chicago School. Right-wing academia, Milton Friedman, and I can spend a few minutes on this because it might be interesting. I think most people know that Milton Friedman wrote an article in the New York Times Magazine in 1970. It was September 1970. The month is important. I'll tell you why in a minute. Called "The Social Responsibility of a Company is to Increase Its Profits." And this is generally seen as the beginning of a movement to say that the company should only be run for shareholders, and if it's not doing that, it's being run inefficiently, and you should get rid of the managers, etc., and take the money out of that company, put it somewhere else through the stock market. The guy
what date did you say that was?
That was September 1970. That was also if I knew everything I knew now, I could have been a genius, because that was the month I started a PhD at Harvard, and if I'd been able to really get right on top of what Milton Friedman was doing right at that point in time, I would have been 2 decades ahead of myself. But I had to go through the learning process, obviously. Anyway, that's the way the world works. We have to, catch up with this stuff. But that's what was coming out of Milton Friedman's mouth. That was picked up by a guy named Michael Jensen, who was at Rochester, University of Rochester, which was kind of a right-wing version of the extreme right-wing version of the University of Chicago. He ended up getting hired at Harvard Business School in 1985. I was there at the time, and he turned Harvard Business School into a proponent of shareholder value ideology, and that legitimized that whole ideology. Now, okay, let me go back to Milton Friedman. I had read that article many times because it was reprinted, but it was only maybe 10 or 12 years ago that I saw it in its original version on a PDF as it appeared in the New York Times Magazine. And it was done in a particular context. May of that year was the annual general meeting, the meeting of shareholders of General Motors. At that meeting, and this is fully told in the magazine article at the beginning, there was something called Campaign GM. It actually came out of, it wasn't Ralph Nader wasn't directly involved in it, but it came out of Nader, who had written Unsafe at Any Speed in 1965 about, and focused a lot on GM and its cars that were unsafe, right? So there was a Campaign GM. They wanted to put 3 people on the board of directors of General Motors for public interest purposes, public interest representatives, not shareholder representatives. They wanted them to represent 3 things. 1, safer cars, less polluting cars, and diversity. So actually, they already had one person who they named, the name of the person who would be the African-American person on the board. Okay. There were a number of African-American members of Congress who had recently been elected, and there was a big increase in African-Americans in Congress in 1968-70, including Shirley Chisholm, who were involved in Campaign GM coming out of Congress. And I think it actually had something to do with the formation of the Black what do you call it? The coalition in Congress in 1971. But basically, that was put to a vote of shareholders. It was defeated at the 1950 meeting. At the 1970 meeting, May 70 meeting. The chairman of General Motors then appointed a subcommittee of the existing board of directors to look into whether they should be producing less polluting cars, safer cars, having more diversity and employment. Okay. Someone at the New York Times recruited Milton Friedman to write a comment on this, and the comment was written in reaction to them even just having a committee investigating these social purposes. Okay, and if you read that article, Milton Friedman says that, for example, that at General Motors, they are hiring previously homeless, unqualified people to take the jobs of experienced workers. He was talking about affirmative action under EEOC. They had a picture. It's very grainy in the New York Times. I'm trying to get the original, but it appears that he's talking about a black worker. He doesn't say it's a black worker, African American worker, but that's what he's talking about. Okay. He argues that, there's rules about pollution. You don't need to have these protesters trying to change this. You don't need. So he calls this pure and unadulterated socialism. Okay. Now, the interesting thing is that if you look at, now we know where the automobile industry went from there. The companies that won out, including the Japanese and the European companies, but not so much General Motors, were the ones that produced safer cars, more fuel-efficient cars. General Motors actually did benefit from more diversity in its labor force because, and I have a book coming out on this, in the 1960s and 1970s, there was a huge demand for blue-collar labor still. The employment in automobiles was growing and in other mass production industries. white workers were in less plentiful supply because the children of white blue-collar workers were getting university education going into white-collar work. The 1960s was the lowest decade for immigration in probably U.S. history, at least since the early 19th century. And so black workers got lots and lots of jobs and moved into semi-skilled work in the automobile industry and related industries.
It seems like you just made a case for it sounds like Milton Friedman was just like a hardline conservative who valued profits over everything else. But how does that transform into this shareholder value system?
Because he's saying,
because there are two different ways to distribute profit ultimately, right? Like you could still be a fan of profit and not be giving it all away to your shareholders.
Right. So his idea had to get developed further. Now, thing I'll say about Milton Friedman is he didn't know the first thing about how a corporation ran. There's nothing in any of the stuff that he wrote that would say that he had any familiarity with business practice, corporations, etc. This was just pure ideology coming from this. The other thing I can say is that in the textbooks to this day, what is being taught by people at the Chicago School, but also people at Harvard, MIT, the East Coast liberals. His counterpart in the 1950s and 60s was Paul Samuelson, who's had the most popular textbook in economics, was Mathematical Economist at MIT. I don't know how much you want to get into this, but basically what PhD economists are teaching undergraduates and have been for 75 years, year after year after year, is that the most unproductive firm is the foundation of the most efficient economy. They actually have a theory of the firm that makes it just markets really are the ones that dominate. Perfect markets are what are the height of efficiency, which is total nonsense. I could go on and explain why that's the case, but
which essentially translates to fixation on financialization.
Let the markets work, and in this case, they're saying let the financial markets work, and particularly the stock market.
But where does that come from? Like, why? That seems like a values. That seems like a values decision that occurs.
Well, first of all, it comes. What part of it comes from a myth, and that is the myth that the stock market, let's say, in 1970, that if you look back at the growth of U.S. industry, the stock market was funding U.S. industry. It wasn't. It was a way in which you exited from companies like a Carnegie or a venture capitalist or someone who started a company or Hewlett and Packard. You took some of your money out. They stayed on as managers there for a long time because they were good at doing that. But the here is now saying that all of those profits belong to shareholders, and that.
Is this like a trickle down ideology where he's basically like making the argument that, okay, so if you give all of the profits to shareholders, then shareholders will come to associate stocks with being profitable, and they'll invest more money in the stock market, which will give these companies even more money, and which will eventually in some way enrich the lives of the people that are working inside of them. And so in some ways it seems like a proto trickle down ideology.
It turns into that, but really what is at the heart of it, and it took a while before it was really until the 1980s with this guy Michael Jensen in the lead, who died recently and later sort of in a kind of funny way said that he had kind of been errant in his ways, but anyway, he created this ideology that was a fantastic ideology for looting companies. And basically, it was saying that the only people who take risk in a company are shareholders. Okay, nobody else takes risk because everybody else gets a guaranteed payment for what they're doing. And so if you think of it just as workers and shareholders, what they're really saying is you come to work for me, I'm paying you a wage, you do the work, and the profits then are there. I'm taking the risk of whether there be profits or not.
Okay, so I have a question. At what point in history does this shareholder value ideology start to get fixed in the minds of people that are running companies? Does it happen immediately after Milton Friedman publishes the 1970? Does it take until like 2000? Like when does Jensen publish? Does he publish something specific on shareholder value ideology? Is there
Yeah,
a
so
seminal work.
It's kind of percolating. What Jensen did with a guy named Meckling, who was at the University of Rochester, they wrote a paper which normally would have been obscure, but because people were looking for something to say, that shareholders really are the ones who have a claim on what they call the residual, which really the profits, what's left over after you paid everybody, that they're the ones that have to decide what to do with this. Those papers started getting written. First big one, which is one of the most widely cited papers, 1976, and then a number of them up in the early 1980s. But this was not at that point yet being argued in boardrooms, although some people were trying to push it. I would say that the seminal change was when Harvard Business School, where I happened to be at between 84 and 86, hired him. And they hired him because the president of Harvard and the dean of Harvard saw that that's where the money was. Okay, so what happened really, and it started happening under Carter. There was all the deregulation. And then certainly under Reagan, it was all about that. And mergers and acquisitions, of buying companies, selling companies, breaking them up. It culminated with RJR Nabisco, which was a big thing with the company KKR, sort of making billions of dollars, breaking it up. That became really Wall Street started making money out of deals. Now that I'll give you the background to that. In the 1970s, what did happen, and this is where you get to the financial sector, coming into the 1970s, Wall Street was making its money by funding investment. So they would fund municipal bonds, federal government. They'd fund companies, their long-term bond issues when they wanted to invest in new plant and equipment. That's how they funded them, with profits and long-term bond issues. That all changed. That Wall Street stopped doing that, but trading became much more what Wall Street was doing. And that was facilitated in part by computerization. So the creation of NASDAQ, as I said, was basically the first application that I know of internetworking. And it was actually the Securities and Exchange Commission had something called the Special Study. It's the only one it's ever had in 1963 to say, how can we get startups coming out of the military industrial complex? And they said, well, we have to make these over-the-counter markets more liquid. Now, what was happening is all these dealers were on their phones with, I guess, the equivalent of Rolodexes, is that's what they were using then, calling people, trying to buy and sell shares. Nobody knew what the price of a share was on any day. The next day, you would have in Wall Street Journal publish what they think the average share was of these over-the-counter stocks. But what NASDAQ did, it wasn't really a trading exchange at first. It just gave you instantaneously, you could see what the trading in the stock was and who was doing the trades. And then you could be in touch with those people and do the trades.
Which means that you can make more trades per unit time.
And it became more liquid. You could get your money out easier. Okay. And it was a speculative market. So Intel, going back to Intel, let's take Hewlett Packard. Hewlett Packard started in 1939, went public in 1955 because Hewlett and Packard wanted to take money out. Intel, founded in 1968, went public in 1971, one of the first year of NASDAQ. They had profits, but they didn't have to have a big track record. There was much less stringent listing requirements, much more speculative. And so this actually was great for venture capital. And in 1972, out of Silicon Valley, you have starting the formation of what became the National Venture Capital Association, and venture capital starts emerging as a distinct industry. They had trouble getting money, venture capital, from pension funds. That was in part because of legislation in 1974 called the Employment Retirement Income Security Act, ERISA, which said to pension fund managers at companies, like let's say General Electric, you could get fined, thrown in jail if you're not a prudent man, it was the legal term, in using the money that you're investing and put into assets that are too risky. Okay, this was then something that the venture capitalists Association lobbied to change. ERISA was overseen by the Department of Labor. There was an obscure ruling of the Department of Labor, came into effect July 31st, 1979, that changed that prudent man rule. And that said that you were not going to be judged on any one investment in any particular company. It was your whole portfolio. So if you put a small proportion of your portfolio into some riskier investments, and it came to be seen as either 5%, 10%, that would be okay. You would not be charged with being imprudent and risking, people's money. Okay. That immediately led to a flow of money into venture capital. So from basically August of 1979, there's never been a shortage of money in venture capital. It's always been, are there enough firms out there that you can back that actually have a new technology that's ready to get to the market, or that can do an IPO that people will believe is going to generate, profits in the future, even if it doesn't have them now. And then in 1980, you have Apple goes public, Genentech, that's in, microelectronics, of course, in biotech, Genentech, do big initial public offering, and you're off to the races. And now everybody's speculating in these new startup stocks. Those companies then now have a vehicle, and they're all listed on NASDAQ. They have a vehicle they can go public fairly early. Now, this becomes important to them because they're recruiting people from the old economy companies with stock options, broad-based stock options. And so let's take the example of Microsoft, which was founded, I think, 1975. 1981, they 82, I think it is, they start giving everybody stock options. They have the IBM franchise. They're growing. They go public in 1986. They didn't need to go public to raise money. They were doing fine. They went public because those stock options had vested after 4 years, and either the company was going to have to buy them back, or the employees could sell them on the market. So they put a portion of Apple stock, of Microsoft stock, on the market, so the employees could cash in their stock options. Okay, so stock options were driving this use of the stock market. Companies then started, as they were giving out stock to employees, I've documented this for various companies, they started seeing this was diluting shareholding, okay, because there's more stock there out on the market. So some of them started to buy back their stock to offset that dilution. But once they started doing that, they saw, hey, this is a good way of just increasing your stock price. And as it turned out, many of the old economy companies that were losing workers, that had been the victims of conglomeration or whatever, that were being captured more and more by financial people rather than production people, they said, hey, this is what companies we run for. When Jensen came there to Harvard Business School, and I saw this happen in 1985, he sold this bill of goods that, that's what companies should be run for. The executives started to come to Harvard Business School to learn that. The MBAs started going. They were going to Wall Street already. Now they had a legitimizing purpose. They weren't going into physics. They were going into becoming MBAs and going to Wall Street. 1984, they were not talking about maximizing shareholder value. I didn't hear it at Harvard Business School. 1986, it was dominant. And you see that with hits in the Financial Times, Wall Street Journal. In turn, people have done research on, searches on this. That's when it starts. Then it becomes dominant. Then they argue top executives should be paid in stock to align with shareholders. And everybody accepted that. And by I mean everybody, hardly any. I was a critic early on. There weren't too many of us. Basically, this was something people just accepted. Liberal, conservative, even progressives. The stock shareholders own the stock. That's their money. They should be able to do what they want with it. And that exists to this day. So Bernie Sanders, have you ever heard Bernie Sanders give a critique of the stock market?
No.
Probably, but can't remember.
No, there is no critique. I mean, he'll talk, because of the work I did, I got people like him talking about buybacks, but the people around them do not understand what's going on there.
So yeah, like I'm trying to bring this back to something that has a handle on it. And basically it seems like what you're saying is that in the most simplest version possible, corporations decided that it was better to spend their profits on increasing stock price rather than reinvesting in their workers because of shareholder value ideology. And I'm like, why if they're spending money to make their stock prices higher, but they're not actually spending money on R&D or product development or whatever object of value that they produce, aren't they just shooting themselves in the foot? Like, what company would go for this?
Are they making money off of these off of working inside of the financial industries themselves, like acting like little hedge funds through their own investment portfolios? Because I heard somebody say that recently, that like a lot of companies don't make money by products and services, but by reinvesting in financial structures, essentially.
Well, okay, so let me try to summarize. You're asking the right questions, and I think that there was some resistance to this in boardrooms. And okay, the board of directors gets to appoint the CEO, but the CEO often appoints the board of directors. And in the United States, so whoever gets to be the CEO, either whether they're appointed by the board of directors or appoint the board of directors, they're all in it together, generally. There can be some resistance at some point in time. Boards started getting populated by people who bought into this shareholder value ideology. And meanwhile, the top executives themselves were getting stock-based pay, stock options. Now it's more stock awards. It's different. But in any case, if they could get the stock price up, they were going to enrich themselves. And they started being judged by that.
But this just seems like a Ponzi scheme. Like, who in their right mind who's running a company that wants to see the company survive and succeed would be like, we should put more money into artificially inflating our stock prices?
Okay, well, let me tell you who in their right mind. I can give you the names of them.
Are we sure?
Craig Barrett. Okay, Craig Barrett.
Well, the point is, these are not life. These people aren't staying in one company for life. That's why that thread of the disappearance of that culture is important.
Yeah.
Okay.
Well, let me finish. Let me give you this example, because it's in the news and it's illuminating. There's a company at which you had a guy named Craig Barrett, Paul Otellini, Brian Kucinich, and I think it was Robert Swan, were successive CEOs. You know what the company that is?
Mm-mm.
Intel.
Mm.
Intel, the most important company probably in the microelectronics revolution. Okay. They were there from 1998 until early 2021 in succession. When they were running Intel, they did $145 billion over about a little over 2 decades in stock buybacks, as well as paying dividends. But it was mainly stock buybacks. Okay, during that time, while they were doing as much as 10 or 15 billion in buybacks a year, particularly under the guy Otellini, who was the first one who was a finance guy who was hired to get the stock price up between 2005 2012, they didn't. One thing which has come out in the news, they could have acquired an AI company, NVIDIA, for $20 billion. They spent more in about 3 years on buybacks than it would have cost them to acquire NVIDIA at that time. They could have been in AI.
Why? Yeah, why?
Yeah, that's the part that I don't understand. Like,
why? Because okay, I call it. I talked about retain and reinvest. I had another polar to that, was downsize and distribute. They were dominating distribute. Intel had been a leader, and was, until I haven't seen the latest figures, but was one of the 1 or 2 the leader in chips worldwide right into the last couple of years, even though now they're in real trouble. Okay, so they were making lots of money from their x86 architecture, being inside the computers, having that, dominating that market. They were also fabricating those chips. But so they thought, why should we invest in other stuff? We can get our stock price up. And they were told that's your job. Now, I don't know what went on in the boardrooms, but the boardrooms were going along with this, and they were saying, yes, that's your job, get the stock price up.
Okay,
Now,
so then the question, I guess, the loop we haven't closed is, why does buying your own stock, this might be stupid as hell, I'm really sorry, but why does buying your own stock raise the price of the stock?
Is it just pure demand? Like,
yeah. Okay, so I call it the buyback process. There's really four stages to it. Okay, a company will announce that it's doing a stock buyback, a big one. Let's say a $10 billion stock buyback. They might say over the next 4 years, or the next 2 years. They might say over an indefinite period of time. That would usually happen at an annual meeting. The board will say, we authorize the CEO, the CFO, at any time they want, on any day they want, to go tell their broker to go into the open market, that is the stock market, and buy back a certain amount of stock. Okay. That then is in place. Now, it's been documented that when companies make that announcement, there tends to be a 2 or 3% bump in the stock price. Now, you could say that the stock market would say, oh, well, that company is shooting itself in the foot, like you said. So there should be a downgrading of their stock because they're giving away money. And who are they giving away to? They're not giving it to shareholders. They're giving it to making advantageous for you to sell their shares, share sellers. If you know when the buyback is being done, you can make money. Now, if I go buy shares, as much as I know about stock buybacks in any company, I have no idea when the buybacks are being done. For one thing, there's a rule from 1982 from the Securities and Exchange Commission, which says that you can buy back a safe harbor. You can buy back a certain amount per day, which can be massive, without being charged with manipulation. But the Securities and Exchange Commission does not know those days. Since 2004, we know the months they did them in retrospect. But if you know when it's being done, and anybody who's a hedge fund knows when they're being done because they're watching the broker through whom they have to do it, they can buy and sell around that buyback. The executives inside know when it's being done. Okay, so but that's how you make the money. Now, the second thing way the stock price goes up is when you actually have the broker go in there and demand the stock. It can have an impact on the stock price just because you said demand. There's an increased demand. Now, it's not a small amount. Apple, under this, it's called Rule 10b-18 from 1982, which we call a license to loot. Apple can do, last time I looked, and it changes depending on trading volume and price, could do $4 or $5 billion a day of buybacks without being charged with manipulating the market. Microsoft could do about 700 or 800 million a day, day after day after day, without being charged with manipulating the market.
That's insane.
Okay, so that's what now. Okay, so that's driving the stock price up. Then you're going to, when that happens, there's going to be some people who don't really know that there's a lot of buybacks going on, but they see this momentum on the stock, and they're watching that, Jim Cramer, Mad Money, or some crazy thing, and there's a momentum on the stock, buy the stock, and he's going crazy about this, and so they start speculating on the stock, and it goes up further. Once you give stock momentum, and so the interesting things is that companies buy their stock in the boom when it's expensive. They don't buy it when it's cheap. They buy it when it's expensive to try to keep up with everybody else. Okay, so when Apple's doing $95 billion a year, they can afford it. They have all the profits, but they're raising the bar for everybody else to keep up with them. Okay, that's the third thing. So you get this. So you get the announcement, the actual buyback, the speculation. Then they issue their quarterly reports or their end of year report, and there you can see the impact on earnings per share. Okay, and what shareholders care about is not whether the shares have gone down and earnings have stayed the same, but whether earnings per share have gone up. And then, if earnings per share have gone up, they'll, say, hey, the company's doing great. Now, part of this, when you look at the bigger picture, is the other impact of this is that because so much money is going into buybacks. So if you take the S&P 500, we haven't quite updated to 2023 yet, but if you take it for, we usually look at a decade for the companies that were listed over the whole decade in the S&P 500. So there was something like 476 companies that were listed from 2013 to 2022 for the decade, 10 years. And you look at the amount of buybacks they did, I think it was something like 6.4 trillion, 54% of net income, and another 40 something percent in dividends. Okay, some companies are actually paying, it's more than profits because they're eating cash, they're laying off workers, they're selling assets or whatever. Okay, but companies are spending almost all their profits, maybe even more, even over a long period of time, pumping up their stock price. What that means is that if I go into the stock market now, and I know that if a company like NVIDIA, which is hugely profitable, or a company like AMD, which is hugely profitable, and in the past that they didn't do buybacks or even pay dividends, that they're going to do so in the future. And so that they're going to support their stock price. And so when I go in there, it's not simply that I'm going in speculating. I'm going into a company where I know that they now have what is now in every annual report called the free cash flow that is going to be devoted to getting my stock price up if I hold the stock. And then I'm going to think about, okay, when is the best time for me to sell the stock to make money? And it's going to be when these companies are really supporting the stock price, but maybe running out of steam. If you can now, obviously, not everybody knows when they run out of steam, but that 145 billion that Intel CEOs spent before they brought Pat Gelsinger in meant that that company was not going to be able to catch up. They were out of the picture. They turned down the contract for the Apple microprocessors in 2007. Apple gave that to the Koreans and the Taiwanese, and Intel's trying to catch up. They brought in a guy, in this case, who was a production guy. He actually was one of the few CEOs, the only one I know, who took the job, telling the board that he no more buybacks, and he's now just been fired because they haven't been able to turn around the company. No fault of his own.
Hey, if you're doing all these buybacks, how is your earnings per share going up?
Because you're okay. You can have stagnant earnings or even declining earnings, but earnings per share, it's a numerator over denominator. Buybacks take away the denominator.
Oh, so your shares no longer count against the pool.
That's right. If they're in the treasury, it doesn't really matter. They might retire them, might put them in the treasury.
I see.
Okay, so
wow, that's really interesting.
This is crazy. This is like where I wanted to get to, because I feel like we have just a few minutes left, and I want to be able to put the pin in this conversation so we have a handle to pick it up from next time. Because something clearly happened to the American economy, maybe even to the global economy, starting in 1970, that is still unfolding today. And I think that this financialization of the stock market, and the stock market being representative of how good the economy is doing.
The financialization of firms, it sounds like. The stock market's kind of always been there.
Yeah, absolutely. So it's like, it seems to me that there's something about the financialization of these firms where if the stock market used to be a relatively accurate representation of the profitability and functionality of a firm, these sorts of programs are eroding our ability to actually see what's happening behind the veil, because you're able to do financial machinations that artificially inflate your stock price. You're not investing that money into your workers or into your technology.
And investors are operating quite algorithmically, right? When we talked about index funds earlier. And so
so the index funds, their function really is to make the market much more liquid. There's more, we have our money in there. The real power, which I didn't get to talk about yet, is the hedge funds. And people like Carl Icahn, Nelson Peltz. So you have.
I mean, I honestly, I feel like we're going to have to talk again, because I actually have to go teach at the university. So I would stay longer if I could, but I can't today of all days. And I feel like we're just getting to a point where I'm understanding the points of how this hinge happened. But there's still the whole modern future that we haven't made it to.
And I think that this is what I love about conversations when it comes to subjects that Shaila and I don't know a ton about, is that there's always this process of getting up to speed, understanding the larger narrative, the historical aspects of it, in order to be able to actually ask intelligent questions about the present. And I feel like over the course of the last 3-ish hours, we've gotten to the point where I have, at the very least, I have a solid reading list for like where to go and what to look at and how to expand my lateral understanding of this. And it would be really cool maybe in like January or February, because we're about to stop recording for the winter season. So like to come back in January, February, and then pick this conversation back up at hedge funds and private equity and all of these novel machinations that are
institutional investment.
Yeah.
And what's happened to the labor force as a result.
Absolutely.
The insecurity that the labor force is facing is, I would argue, and we can talk about that, as a direct result of this. I think it has huge political ramifications, because if you don't deal with these issues of corporate financialization politically, workers are going to say, well, who's going to get me out of this paycheck to paycheck syndrome? So there's a lot of things that come out of this that we haven't even touched on yet. So
all right, if you can make time, I would love to talk to you again about and finish this story. I think that there's just too much here to try to cram into 5 minutes.
But I think that we do have now a solid model of what the firm used to be, and that something happened in the 1970s that dramatically changed.
It seems in some sense technologically driven by the ability to do these lightning fast transactions and keep a momentary eye on. There's a technological story behind the scenes here, which is fascinating.
Oh yeah, definitely, and that's and it's really a question of who gets to use the technology for what purpose. Of course, we're having that debate with AI now. But you have revolutionary technologies. The question is who's going to control them for what purpose, and you can clearly see the financialization of AI going on right now. I don't think it augurs well, at least for the way it's going to be used, because it's going to be used by people who just want to figure out how to make more money out of money with it.
Well, NVIDIA's $50 billion stock buyback that is starting next year seems to suggest that things are going just fine.
Well, no, and I'm sure, Jensen Huang, the CEO, built up that company. I don't think he wants to do stock buybacks. He's afraid of hedge funds. We can talk about that next time.
Let's do it.
Right there.
Bill, thank you so much. It's obvious that you've spent so much time thinking about this and you have such a complete map, and I really appreciate that you were patient with us as we clung on for dear life for the ride.
Well, it's always a learning process.
All right. Well, thank you so much.
Yeah, have a good holidays, and I hope we can catch up again in the new year.
Yeah, definitely. Let me know when it's good for you.
All right.
Okay, thanks so much.
Take care.
Bye.
Bye, everybody.